So I get asked all the time, Tyler, what will start the AMC short squeeze? And there is one thing among many other factors that will align, but one factor in particular that will 100%, in my opinion, cause the AMC short squeeze. It's pretty straightforward and simple. So we're going to get into what I do think will cause the AMC short squeeze, as well as go over the proof that this is actually a thing and that it is coming in the near term future. So with that being said, hit that like button for me, consider subscribing to the channel and sticking around a while. Now, let's just talk about AMC for a brief period. Yes, we are in this consolidation phase in between about $40 and $60. $40 being a major support level and $60 being a major resistance level. So eventually we're going to break out, I do believe, to the upside. I think we're going to see a bounce later throughout the rest of this week, but this is not really what is important here. This really comes down to the double-edged sword effect that I have been talking about. Put yourself in the hedge funds and institutions position if you are short on AMC and you are seeing the stock market going down. Keep in mind, these hedge funds, institutions, they have more than one position. They have multiple positions, sometimes hundreds of positions, whether that's in long stock in companies that they're invested in for the long-term future, the overall stock market. And then you do have these hedge funds, institutions that are short in stocks like AMC. Now, on one end, you're going to see the stock market going down, and in my belief, like we did see on this huge bounce on Thursday, up about 10% with regular trading and after hours, you're going to see AMC going up as the stock market is going down. So shorts in AMC are going to be losing on their long positions in stock throughout the rest of the stock market when this happens, as well as losing on their short positions, essentially giving them no choice but to cover their short positions. Because if you're exposed to unlimited risk on a short position and a stock is about to short squeeze, you're going to be more likely, obviously common sense, to close that short position instead of closing your longer term positions that will eventually make you a lot of money. There is no arguing there. That is the only logical common sense thing to do if you are a short seller in AMC stock once the market is dropping and AMC is ripping. And I do think you're going to see that inversion. Like I said, stock market going down, AMC going up. Same thing that we did see Thursday. Like I said, AMC up about 10% with normal trading in after hours. The stock market as a whole was down about 2% at the lowest moment during the day on this Thursday. So I think here is the telltale sign of the proof that that inversion is actually going to happen. But when it does come to the overall market sell-off and this double-edged sword effect, obviously the one key catalyst that I am talking about is the market coming down. That is logical. If you guys don't understand that yet, this is very important for you guys to fully understand what I am talking about and what I do think is going to happen. But keep in mind, I'm not a financial advisor or a financial planner. This is some random guy on YouTube giving you guys his insight in what he thinks the short squeeze is actually going to be caused from. And like I said, there's going to be multiple things, a plethora of different things going on at the same time, but this is logically the number one thing that will actually cause the short squeeze. And take a look here, new 52-week high on the S&P 500 today. So we are at all-time highs, arguably overbought and due for a correction. I don't think anybody argues that fact here. And when you do take this into consideration, with the overall margin debt in the United States stock market at $861.6 billion, that is over double the margin debt during the last recession of 2008. I know 2020 was a recession, but really 2008 was the last extended recession that we did have, where the stock market didn't even reach its highs in late 2007, 2008 until about 2012. That was a 4-year dip in the S&P 500 and the overall stock market alike. Now, when you add all these two factors together, you're looking at the market potentially coming down for a crash or correction. You're seeing margin debt at all-time highs. And what happens when the market comes down and you're losing on collateral to stay in your short positions, aka just long-term stocks? Like I said, you're going to see shorts having to liquidate their short positions. And this will happen very fast and it'll be very hard, this de-leverage situation. Now, what is actually sending red flags that the stock market is getting ready to go through a crash or correction? It is simply China is cutting its RRR rate, the reserve requirement ratio. So the amount of money that banks have to keep in their reserves for their clients in case some kind of event happens. So it essentially lets out more liquidity into the marketplace. It makes it cheaper for people or companies to borrow money, and it's supposed to stir up the economy. Instead of America like cutting rates, China likes to cut their RRR rate to just get more money out into the system without cutting their interest rates. They rarely ever cut their interest rates, but that will play a key role in what we were talking about as well, and we will get into that in 1 second. But I do want to read some of this article, not very much, but it gives you an idea of what is going on here, just besides me saying this myself. Now, it says, China broad-based RRR cut sends bad signal. The Chinese government has unexpectedly announced a broad-based RRR cut to be effective July 15th. This is not the targeted cut mentioned in an important government meeting and sends a bad signal. So why does China need this cut? What's wrong with the economy? How much liquidity does this RRR release? It's surprising that the RRR cut is broad-based and not targeted at SMEs, which was mentioned in an important government meeting, and even more surprising given that overall economy appears to be quite strong, a standard post-COVID recovery story. Let's go through the policy step by step in order to draw some insights. This is a 0.5% required reserve ratio cut, which will release long-term liquidity of around Chinese yuan 1 trillion. This compares to Chinese yuan 185.5 trillion of total loans outstanding at the end of June 2021. The major banks RRR will be to 12% after the cut. This is a broad-based cut, not the targeted cut mentioned in the government meeting. So in essence, all banks deposits can enjoy a 5% reduction in required reserves, as most deposits eventually turn into loans. Banks will enjoy larger profit margins if interest rates do not change. What's wrong with the Chinese economy that it needs such a cut? My own view is that the main intention of this cut is to help banks with their capital and liquidity requirements. From the Q&A written by the People's Bank of China, we understand that this RRR cut aims to increase financial institutions' capital and liquidity and lower their cost of doing lending business. This gives me a sense of unease. Are banks under stress? If this is the case, it implies there could be bad loans. These bad loans could stem from recent deleveraging reform. Banks have not been able to lend to real estate developers as easily as before and have shrunken their mortgage business. Fintechs, which banks also lend to, also have been subject of deleveraging reform, and this may have had some impact. Overall, what you can get out of this is the Chinese economy needs more money, and it is starting to slow down. China was the first to go through the pandemic, as we do know. They were the first to recover from this. So China is about 3 to 6 months ahead of where America is as far as getting back to normal post-pandemic. So that is why this is important. With the economy slowing down, that sends huge red flags to American investors. And once you do start to get that bad FUD going around in the investor marketplace, financial media, etc., you're going to see a lot of fear go into the stock market very fast. But it's very important to keep in mind, this is no speculation. This is all facts. And we're going to get through when China actually cut their rates and what happened to our stock market in just 1 second. But I do want to point out, them cutting the RRR rate is not going to cause a stock market crash or correction, or at least it shouldn't, because that is not huge news. But what this implies is that the Chinese economy may need a rate decrease, and the Chinese interest rate is at 3.85%. So there's definitely room to come down from here. And if cutting the RRR rate does not work, that will be the next thing that they will do. That will 100% cause a stock market crash or correction. And considering the severe over leverage that hedge funds, institutions, and even normal investors do have in the American markets, that's why I do personally think it could be fast and it could be hard, but this could still take 3 to 6 months out. I do plan to hold my AMC shares for 3 to 6 months out. I'm not really trying to give it a timeline, but this could happen soon. It could happen later. That is what you guys have to keep in mind right here. And this is the China loan prime rate. And this is essentially China's economy's interest rate. Now, what is important to note here is not really 2015, where they did cut rates a lot. That did, yes, have a bit of a correction, about a 5% correction in 2015. When that did happen, a little bit over 5%, around 8% correction when that did happen in 2015. But what is more important to note here is 2019. This was actually about a 15% correction that only lasted about 3 months from start to finish. So this was very fast in the overall grand scope of crashes and corrections in the stock market. And this was directly due from China cutting its interest rates in 2019 3 times. See, once, twice, 3 times going into 2020, once, twice in 2020. Their interest rate was at 4.3% before 2020, well, before 2019. During about August, they started cutting rates in 2019. That sent the American economy down about 15%. That is what is very important to note here, guys. We will 100% see a crash or correction if China does decrease its interest rate, and I do think that is on the near-term horizon. But another spectra of this is if the American economy just gets red flags that it's starting to slow down in general. That would also be a cause for a crash and correction. So when you do boil this down, it really comes down to the fact of a stock market crash makes long equities in hedge funds and institutions go down, as AMC is likely to invert that as more people start buying the stock because it's positive and apes are not selling out of their shares. Ultimately will drive AMC up, and they're going to be losing on both sides. This is the double-edged sword effect that I've been talking about in a couple videos now on this channel, but we are also seeing the first signs that the American economy might be starting to slow down, and this is obviously, you guys have seen this. Wells Fargo is shuttering its personal lines of credit program, anywhere from $3,000 to $100,000 in personal lines of credit, which lines of credit are seen as less risky than other forms of credit, and they're usually lower than credit card interest rates, things like that. And credit cards are seen as a personal line of credit, a revolving line of credit. It's just there, you use it, you pay it off, you use it, pay it off. But nevertheless, Wells Fargo is the riskiest bank there possibly is. So when you boil this all together, it looks like a crash or correction is imminent in the stock market in the next, I would say, 3 to 6 months. These things can take a bit of time to pan out, but when it does happen, it will happen very fast. Shorts will ultimately be forced to cover their short positions in AMC stock. That is what is important here, and that is what I want every single one of you guys to be made aware about. Now, we're also going to see other events start to happen at the same time. We might see positive AMC news. We might see a gamma squeeze. We might see shorts starting, well, we will see shorts starting to cover when this actually does happen, but there can be multiple things that happen at the same time. But I do think this will be the one thing that really drives AMC's share price home. So that is going to conclude this video. Hit that like button for me. Consider subscribing to the channel, as well as check out the links down below in the description. I have a link for public, no deposit necessary, no need to link a bank account. Get up to $70 in your choice free stock. It is literally free money, and it takes about 3 minutes time to sign up with that and get your free stock, as well as deposit $100 with Webull. Get 4 free stocks, each of them potentially worth up to $2,400 a piece, as well as if you guys want to be notified every single time a trade is made in AMC or any other stock, check out the link for the buy and sell alert to join a community of about 40 members strong. And we make trades on stocks, options, crypto, whether it's a day trade, swing trade, or long-term investment. We have been killing it, so check that out. But the most important thing of all of that, make sure to comment down below. Let me know what you guys think about this information. I think it's pretty straightforward, and most of you guys would agree with the logic here, but nobody is talking about it, so I figured I would make a video talking about this exact same thing. With that being said, I will see you guys in the next video.